So according to many comments on my other videos, I'm an AI, which is flattering, but sorry to disappoint, I'm just an accountant. If I was an AI, I'd make every day a good hair day and I'd give myself better teeth. But what isn't artificial are the rumours about this 20% exit tax. And no, I didn't make it up for views. The Treasury really is modelling it. It's in The Guardian, The Times and The Independent, everywhere. So if you saw someone in the comments saying I was lying about the budget video, this one's for you. So let's pull up the actual sources. The Guardian printed, Rachel Reeves considers 20% tax on assets of people deciding to leave UK. That was published on the 1st of November. The Times, Treasury models 2 billion settling up charge for wealthy immigrants. And The Independent, Rachel Reeves considering 20% exit tax for wealthy immigrants, also citing Treasury sources. So these aren't rumours, they're Treasury briefings, real journalists, real sources, real numbers. So I do get it. People think every viral tax headline is clickbait now, but when you read policy documents for fun on a Friday night, you tend to know what's coming before it hits the news. So what actually is this exit tax everyone's panicking about? Let's strip out the TikTok drama and look at the facts. The Treasury under Rachel Reeves is modelling a new settling up charge which would apply a 20% tax on business and investment assets when wealthy people emigrate from the UK. It's not law yet, it hasn't been announced in Parliament, but it is being actively modelled. This isn't a tax for your average person moving abroad for work or retiring in Spain. It's aimed squarely at high net worth individuals, founders, investors and entrepreneurs. These are the people who've built wealth in the UK, then moved to low tax jurisdictions like Monaco, Dubai, the Cayman Islands. But right now, the rule book says this: if you're non-resident, the UK taxes you only on UK sourced income and UK property. So if you sell your business or shares once you've become non-resident and those assets aren't classed as UK property, the UK can't touch you. That's why people move to Monaco. There's no capital gains tax, no income tax and no inheritance tax. You can sell shares for millions, even billions, and legally pay zero UK tax as long as you've genuinely cut all UK ties under the statutory residence test. The Treasury hates that because those gains were built in the UK using UK labour, UK infrastructure and UK tax reliefs, but they're realised offshore. So this settling up charge is basically the government saying you built it here, so before you leave, settle up. It's a form of exit time capital gains tax, what other countries already do. For example, France and Germany both have deemed disposal rules for wealthy immigrants. Canada treats your assets as if they were sold the day you leave. The US goes even further. They have a literal exit tax for citizens who renounce their passport if their net worth is over a certain threshold. The UK so far hasn't done that. The only similar rule here is the temporary non-residence rule. If you leave, sell assets, then come back within 5 years, HMRC can tax those gains as if you never left. That's designed to stop people doing a quick tax holiday, but if you leave for good, stay away permanently and sell from Monaco or Dubai, those gains escape UK capital gains tax entirely. The new proposal would close that gap by making you pay a 20% exit charge on any unrealised gains up to the date you leave. You'd effectively be deemed to have sold your business or shares at market value the day before you stop being UK resident. So for example, say you own a company worth 5 million today and you bought it when it was worth 1 million. That's a 4 million gain. If this rule existed, you'd pay 20% on that 4 million, so 800k before you go, even if you haven't sold a single share yet. Now, the Treasury insiders told The Times that there might be a deferral mechanism, meaning you can postpone paying until you actually sell, but the tax liability would be locked in the day you become non-resident. They're calling it a settling up charge rather than a penalty. Politically, that sounds softer, but it's still a major shift in how the UK taxes wealth on the move. Supporters argue it's about fairness. Most G7 countries already have something similar, and that if you built your wealth in Britain, you should contribute before you leave Britain. That's the line. Critics, though, say it's dangerous. Announce it too soon and you cause a stampede for the door. The exact opposite of what the Treasury wants. Every founder who's thinking of moving to Dubai suddenly leaves before the new tax hits. That's called capital flight, and it's very real. The risk is that you actually lose the people and investment you're trying to tax. Economically, they say it could raise around 2 billion a year, but only if it's enforced well. Because remember, the ultra wealthy have options, trusts, holding companies, relocation strategies, and those take time to unwind. Then there's the practical side. How do you even value a private company's shares on the day someone emigrates? Who decides what it's worth? Need new evaluation frameworks, new reporting systems, and new guidance. HMRC already struggles to process basic returns. Imagine adding a departure tax on top of that. But the Treasury sees it differently. They need to plug a 20 to 30 billion fiscal gap without touching income tax or VAT, because those are political suicide. So the plan is to hit where the money actually is: wealth, property, and capital gains. And this fits right into that strategy. So in short, no, there's no £500 airport toll, but yes, a 20% exit tax for wealthy immigrants is being modelled right now. It's real, it's in the papers, and if it lands in the budget, it'll completely reshape how entrepreneurs plan their exits from the UK. So let's be real. If you're a small business owner or a company director, this doesn't mean you'll suddenly get taxed for moving to Portugal, but it does mean that how you structure your wealth right now matters more than ever. Because if the UK starts taxing people on exit, then the only people who win are the ones who already have a plan. Think about it. You've spent years building your business, growing assets and compounding profits. If you ever want the freedom to relocate or even just reinvest abroad, you need the right structure in place. That's where holding companies come in. When your trading business pays dividends to a holding company, those profits are already post-corporation tax. You can reinvest, buy property, fund pensions, and even expand internationally without triggering personal tax events. And if this exit tax ever comes in, having your wealth inside a corporate structure gives you far more flexibility than holding it personally. The same goes for pensions. If you're planning to make large employer contributions, it makes sense to do that before any new legislation lands, especially if you're aiming to move funds offshore or set up an international retirement plan later. So while social media is panicking about a 20% exit fee, the people who will actually get caught are the ones who've ignored tax strategy for years. The wealthy don't wait for the rules to change, they plan before they do. And this is exactly why I talk about structure so much on this channel, because it's not about avoiding tax, it's about building freedom into your finances. So if you ever want to move, scale or sell, you can do it without a nasty surprise from HMRC. Scary part is this: policies like this are rarely one-off. First it's an exit tax for the rich, then it's restrictions on pension reliefs, then capital gains alignment. It's the direction of travel that matters, and it's getting tighter. So my advice: use the rules as they are now while they still give you options. Sort your holding company, maximise your pension contributions, and make sure your structure actually fits your long-term goals. And if you want help with that, that's literally what we do at Tax for Pros. Setting up business owners with smarter, leaner, future-proof structures. There's a link below if you want to get clarity before the budget actually drops. So to wrap it all up, no, there's not a £500 fee to leave the country, but yes, the Treasury is modelling a 20% settling up charge that could completely change how wealthy people emigrate from the UK. It's not law yet, but the direction of travel is clear. More tax on wealth, more compliance, and less freedom if you don't plan ahead. To use the rules while they're still on your side. Sort your structure, build your holding company, and make your money work before the government does it for you. I'm Sarah Charlton. No, I'm not an AI, but I am a freaking machine. Don't forget to subscribe, and I'll see you in the next one.